everybody to this kind of a special edition of what we've come to call Market Happy Hour. In the past, all these that we've done have been live. This is a little different this time in that we felt like it was very timely to have our guest expert, Denny McMahon, who's the author of a wonderful book on a very important topic right now in terms of kind of evergrande and spreading potential distress in the financial markets in China. And so things will be a little different for us today, but we really hope it's going to be useful for you. So we're excited about it. So this is our typical disclaimer for our webinars. Remember that we ask that people not record this. You can see and please do read the full disclaimers in terms of the disclosures that are parts of our kind of regulatory responsibilities. And you can go to our website to get more full information on that, but please do avail yourself of that. And then in terms of people who are on our webinar today, of course, we're joined by our worthy director of research and friend for 20 years, Zev Abraham. Thanks for joining us, Zev, and of course our special guest, Dinny McMahon, who's a wonderfully well-placed expert for us to be able to talk about some very important topics today, in particular Chinese real estate, part of the growth model, and some of the questions people are raising now that these topics are very much in the news. So what I'd like to do just really briefly is to, begin by introducing Denny, who's a very interesting person with really an amazing, very appropriate kind of background. And then we're going to talk about a number of questions that we think are appropriate as we kind of do a bit of a deep dive on this topic that's now very much on everybody's mind, which is kind of the Chinese real estate market, what's going on with, Evergrande, how it relates to financial markets, and what might be the outcomes, the nature of the risks. It's just a wonderful opportunity for us to really spend some time and kind of get in the weeds. So just in terms of an overview, just to kind of set the scene in terms of why we wanted to reach out to Denny. And if you could just advance to the overview slide, please. Thank you. So what we, the reason, well, take a step back. I mean, there's so many different things in the markets about which we should care and where we should focus our attention. This Evergrande topic, I think, really is one of importance. And one of the things that we'll talk about in a minute with Denny is, I had first met Denny 10 years ago on a research trip in China, because I was over there very specifically for the purpose of trying to understand the Chinese real estate market, how it was funded, what were the nature of the intricate kind of credit interrelationships, to try to understand it, because as an outsider looking in, I saw a number of similarities in terms of the Chinese real estate market, in terms of how that seemed to me to be fairly similar to what would become, or what people would see in retrospect, was kind of the US housing bubble. And so I went over there for a week to really kind of do a deep dive on that. And I suppose one of the things that really have intrigued me, and why I was so glad that Denny would join us on this call, is just the size of the Chinese real estate market. How important it has been for the global economy, not just for the Chinese market in particular. And I think we'll talk about some of the specifics about how large of an issue this is, how high the valuations are, how strongly the credit flows have supported this, because it's really why we wanted to kind of take a moment and do this kind of special deep dive on this topic, And so anyway, maybe without kind of further ado, we'll just skip over and talk a little bit about our special guest, Denny McMahon. So again, Denny, I mean, welcome. It's good to finally connect again. And of course, we met 10 years ago. You've been kind enough to have a little bit of an occasional correspondence. Of course, I've been following everything you've kind of been done and writing. And one of those things was, of course, that great book that you put together, which now seems, of course, very prescient. China's Great Wall of Debt. And so I've read it, many times, and spent the weekend kind of going back and rereading it for another time. So, like I said, it's great to now that have this topic that people are concerned about, be able to kind of have you on and listen. And so your background, of course, as I said, I met you, 10 years ago in China, because, you were recommended to me as somebody who was very well placed given your background. And of course, it's really impressive. 6 years in Beijing, the Wall Street Journal, 4 years before that in Shanghai. And of course, I believe you wrote the book after moving back to the States as a global fellow there at the Woodrow Wilson International Center for Scholars. So, one of the things that seems to me, Denny, is like everybody now, on Twitter and the financial media, of course, is Evergrande expert, is a Chinese real estate expert. You, however, actually wrote the book on it. So God bless you for doing that. So in my opinion, you are the expert. So if we can just kind of advance, the first kind of question I had, Denny, as I was just reflecting on this, is clearly it's very pressing, but why did you choose that topic? I mean, you were in China for 10 years as a close observer of of kind of everything financial. I mean, how is it, of all the things you could have written about, that you chose to write about this topic?
Yeah, well, I think it was an act of catharsis as much as anything else. So as a journalist, you seldom get to write anything more than 800 words, and occasionally 1,500 if you're really lucky, 2,000. And so I spent years looking at the emergence of China's shadow banking system, but very seldom got to write anything more than kind of a snippet into what I was seeing. So I started with the journal a year after the global financial crisis, give or take a few months. And that was really the moment that China's shadow banking system started to emerge. And so over the following years that I was in Beijing, I saw the shadow banking system just bloom. The amount of debt spiral out of control, the amount of waste and excess in the economy just go from bad to worse. And yet I never really had an opportunity to kind of do justice to all the absurdity that I was seeing and that I was hearing. And so the book, as much as anything, was an attempt to pull together all those various streams to kind of make sense, even to myself, of what I'd been seeing over that period, sort of taking what I was seeing in the shadow banking system and how it related to local government finances, and how that related to the property market, industrial overcapacity and consumption, and just broadly how this entire political economy worked. Because the way that we kind of look at China from the outside is very, very different from how it operates from the ground up inside the system. And so for me, this was, I was writing about this because it was what I was sort of living and breathing for years at the paper. And I just kind of needed an opportunity to make sense of it all.
Yeah. Well, God bless you for finding such a wonderful topic and writing about it, Denny. And maybe a follow-up question to that is, and of course, I mean, you and I are very close to the, why this is important and, why you chose this to run on. But could, in terms of just some of the size and scope of kind of why people should care about this, can you just help people, understand kind of, big picture, like why this is a big deal, why people need to care?
Yeah, absolutely. So about the time I was writing the book, so let's say the end of 2016, China's debt to GDP ratio was about 260%. Now, everybody has their own figure, whether it be the Bank for International Settlements or China, but broadly 260%. Now, as a debt to GDP ratio, that's nothing out of the unordinary. I mean, Japan's is significantly higher, United States, Germany, it's all kind of in the ballpark. But the thing is about that level for China is that, firstly, that is inordinately high for a developing economy. But perhaps more importantly is that the pace at which that number had expanded. So in 2008, China had a debt to GDP ratio of only 160%. And then 9 years later, it was at 260%. Now that sort of expansion, when that's happened in pretty much any other economy in the world, well, firstly, in modern times, no nation has seen its debt relative to the size of GDP expand at that pace. But in any other case where there has been a very fast expansion of debt relative to the size of the economy, it's almost invariably resulted in some sort of financial crisis. And so that is why kind of it's something to worry about, because it really gets to a point when an economy is generating so much debt, new debt year on year, they just run out of places to deploy the money productively. Now, of course, in China, so many people coming out of poverty, you could always build something that is going to be of value to somebody. But that doesn't mean that it should get built today and on this scale and with this amount of debt, because ultimately the asset's not going to sort of generate the return that you need to, to justify its investment. So then to kind of put that sort of debt expansion into real terms, in between that period of 2008 to 2016, the overall debt in China's economy increased by about $12.5 trillion. Now that's about the size of the US banking system at the time. So in that period, China added its own US banking system on top of its pre-existing debt. So that kind of gives you a sense of just the sheer scale of what was going on in China's economy at that time. And I keep referring back to 2016 because that was really kind of the peak point for this sort of the absurdity of this debt creation.
No, those are stunning numbers, Denny. I mean, I can see why you decided to focus on this for for a book. I mean, and maybe say the next question that follows along with that is of course, just for a little perspective, and of course, the Chinese real estate market, as you know, is very, very different from that in the U.S. I mean, and probably most of our listeners are coming in from the U.S. So, I mean, could you just help us, 30,000 view, kind of how, let's say, the Chinese real estate market, it's a very different business, a very different business model, different credit than, what people might, know in the West or kind of the American model. I mean, do you think you could kind of summarize that briefly, just help put that into context before we go deeper?
I'll try. Okay, so let's start with some sort of overarching sort of issues. Firstly, in China, effectively no one owns their own apartment. Now, I know that sounds a bit ridiculous given all we hear about is China's housing market and people paying absurd prices for their apartments. But the reality is that nobody in China owns land. It's sort of baked into the constitution. The government owns land and then leases it. It leases it to farmers, it leases it to industrial companies, and it leases it to property developers or whoever is building an apartment building. And so I might be able to go and buy an apartment, but ultimately the land on which that apartment rests is on a 70-year lease extended by the government. So that's the first thing to consider. The second thing is that China only started to develop a commercial housing market in the latter half of the 1990s. So traditionally, all urban accommodation was provided by the state, and it was provided by your employer because all employers were state-owned enterprises or affiliated with the state in some way. And so much of the China housing boom that we've seen over the last 20 years, it's got real foundations. Because when the state was providing housing, it was invariably low quality, it was too small, and invariably there wasn't enough of it. I mean, you hear stories, even today, of families talking about how they were living in effectively caravans or demountables or glorified tents in the sort of the front yard of whatever office building they were living with. So you kind of had this, the foundations of this property boom is real because people wanted better, larger, accommodation. And of course, as people's incomes have increased, they've sort of upgraded from time to time as they become more wealthy. Now, of course, that's the sort of positive side of the equation. The slightly more, less reassuring side of the equation.
No, you can use the word dodgy. That's okay.
Right, okay.
No, roll with it. You're fine. Yeah.
Is that given sort of the limitations of China's financial system, people have traditionally treated real estate as the primary place in which they park their savings, which is fine. I mean, that's something that happens, everywhere in the world. The thing is in China, though, is that so often when you buy housing for accommodation, you then leave it empty. There isn't that sort of rental culture or rental market that we all take for granted in sort of the United States or developed markets. Why would you buy a house and leave it empty? The whole point is that it generates income by putting people in there. Now, there's a whole lot of reasons why the Chinese do it. Some of it is cultural, but what it comes down to is housing prices have always risen so quickly that there's a sense that it is better to leave this thing empty, ultimately recognize the capital gains, whereas if you bring in the renters will actually detract from the potential capital gains you'll eventually earn on the property. And one of the reasons that people don't rent or they don't need to rent is that there is no property tax. Now, there's a couple of exceptions. There's a trial in Chongqing and a trial in Shanghai, but these trials have been going on for a very, very long time. I mean, they haven't been rolled out much beyond, and even in those two cities, they only exist on a very limited level. So there is no real motivation for people to kind of feel as though they need to generate an annual return from their investment properties. And so then you get this ridiculous situation where, I mean, this kind of to a certain extent feeds into the phenomenon of ghost cities. So often we see ghost cities, these huge developments or freestanding cities in which hardly anybody, if anybody, lives. You've got all these empty apartments. And we look at this as kind of a harbinger of a collapse of the property market. But more often than not, all of these apartments have been bought. And they've been bought because they're investments and, so on and so forth. So that's clearly, that's clearly sort of a big problem in the, in the market. And then, I mean, we can go on a little bit if you like about how developers then sort of finance the, their projects.
Denny, that was a question I was hoping you could just kind of, it's tough to summarize, but, how the financing model is also different, wealth management products, down payments, pre-sales, local government funding vehicles, a little bit, because that's a very different animal from what we're used to here in the States.
Yeah, no, absolutely. So it's, it's difficult to know where to start. Let's take the developers themselves. So the way that developers will fund, just to keep it broad brushstrokes, the way that developers, fund, a development of a housing project is, they borrow from the bank, but they also traditionally they've relied heavily on shadow banking sources, so trusts, wealth management products. Now that's become increasingly difficult for them to do over the last few years because shadow banking has contracted because the government has gone after it very aggressively. And then you also have what they call pre-sales or prepayments, which is effectively people making a down payment on an apartment which hasn't been completed yet. So usually people will pay between 20 and 30% of the ultimate price of an apartment, which will then be delivered to them in 1 or 2 years' time. Of course, there's exceptions. I mean, I've heard examples of people buying very expensive luxury accommodation for the full price. They've paid the whole thing up at least a year in advance. And this is a really important part of the property funding chain for developers, and it's become more and more important over the last few years. So in 2018, pre-sales jumped as a proportion of developer funding because the central government went after shadow banking. And because the shadow banking conduits weren't, they were starting to shrink, well, they had to come up with another source of funding. And the banks were under pressure. They weren't, being told they weren't allowed to lend as aggressively as much to the development sector. And so the developers did do what they always do. They go looking for another source of funding. They started relying on pre-sales more. And it's become even more important over the last 12 months because in the middle of last year, the central government rolled out what it called its 3 red lines program, which is effectively a deleveraging campaign for the developers. So, I mean, we can get into this a little bit later, but it's probably worth mentioning now that it set up 3 metrics for, 3 measures of developer debt. I forget what all 3 of them are offhand, but one of them was, cash to short-term liabilities. But, developers had to have more cash on hand than liabilities maturing in the next 12 months. And there were a couple of other metrics as well. And the significance of these 3 red lines was that if you as a developer were in violation of all 3 red lines, you were not allowed to increase your amount of debt or interest-bearing debt. If you were in violation of 2, you could increase your debt by, I think, 5%. If you're in violation of 1, 10%. And if you're in violation of none of them, I think it was 15% or something like that. And so this, of course, created even more demand for pre-sales because that didn't get accounted as a type of interest-bearing debt. It was effectively free credit for the developers. So they started relying on it even more. One last thing I should probably say about the kind of this whole ecosystem of finance for real estate is where land and local governments come into this as well. Because when, as you would expect, with all land being owned by the government, when a developer needs land, it has to buy it from whatever local government is control of that particular land. And land has become absolutely central to local government finances, to their ability to generate economic growth at a local level, to their ability to get public works done, and even when it comes to all the auxiliary taxes that are generated by both construction and from land sales, it's also become essential just to their ordinary budget, to their ability to provide services to their community. And so the local governments have this incentive to ensure that land sells for effectively the highest possible price. And so often we kind of look at the housing prices in China and go, wow, the Chinese people, they're just bidding up prices. It's a real property bubble. You have to remember that underlying all that is really kind of a land bubble, because there is this incentive by the owners of the land, the local government, to keep pushing up the prices of land to ensure both their own economic viability and their own ability to effectively do everything that the central government demands of them.
Yeah. No, like that's a wonderful summary, Denny. I mean, I was thinking if I were going to add anything to that, it was that this 3 red line policy that came out, I guess it was August of 2020. I mean, that really seemed to be maybe a catalyst for some of this, because that was actual quantitative supply constraints that were placed on the real estate companies, regardless of where they were finding their financing. And so that's kind of new and different. And perhaps that kind of sets the stage. And the other thing I'm very grateful for is that thanks for kind of helping everybody understand how, or at least set the stage for how kind of interrelated all these things are, because it is very much a different animal. In the week I was immersed in this, 10 years ago, kind of traveling throughout China, it was very interesting, but because it was very kind of different, different animal, and so I guess with that kind of outline put out, Denny, I mean, how do you think about, you wrote, you're in China for 10 years, you believe this is a topic, you write about it, 3 years goes by, and now Evergrande is seemingly in the headlines every day. So I guess what's your take on kind of what's taking place, mostly through Evergrande, it looks like it's spreading out, but what's your take on all this?
Yeah. Well, I think what you just said about the 3 red lines nails it. I mean, we are in this position because the government decided that the developers were borrowing too much and they were going to do something about it. Now, of course, that's not the whole picture. I mean, I think even when you were in China, I reckon I've been hearing from at least a decade about investors just shaking their head about Evergrande and going, one day, I mean, that's going to be the domino. That's the thing that's it's inevitable. It's going to topple over.
That's a long discussion, but yes, you're totally right.
So, I mean, the thing about Evergrande is that it is, even relative to its peers, other developers, it is overly indebted. It has this reputation for creative financing, to put it politely, and it has diversified into all sorts of businesses in which it has no competency. And there's really no reason for it to be running its own bottled water company or an electric vehicle company. It owns a fun park. It's done a whole lot of stuff which seems to have more to do with the creative financing than it does any genuine sort of, business reason. So there's a whole lot of reasons here why Evergrande, of all developers, is in such a problem. But really the catalyst here, I think, is the 3 red lines, because it was in violation of all 3 red lines, which meant that it couldn't borrow more debt. Now, in that situation, what it should have done is sell off assets, try and raise new capital, try and fund itself in ways, reduce its debt, reduces exposure, try and fund itself in non-debt ways. Because if it didn't, it was in a situation where it would have to meet its obligations with revenue generated by its existing assets. And Evergrande wasn't set up for that. I mean, so many companies in the Chinese economy, both state and private, they're built for growth at all costs. Profit isn't a primary concern. The game is to become bigger and bigger. It's about market share, and ultimately, once you have market dominance, you can sort all other sins will be forgiven eventually in the future. So Evergrande still had these very aggressive expansion plans, and all of a sudden it was told that it has to meet its obligations from revenue generated by its assets. So what happened? on one level, what happened with Evergrande is kind of, a throwback to the old shadow banking days, in the sense that Evergrande started reducing its debt. Its interest-bearing debt declined by 20% in the first half of this year. But, so it was still about 500 billion renminbi, which is a huge amount of money, but it was down 20%. But even as it reduced its interest-bearing debt, it massively increased its payables. So its payables increased about the same amount that its interest-bearing debt declined. And its payables were a combination of those pre-sales of housing that I was talking about before. And it was things like just deferring payment to suppliers and contractors. And this is really where Evergrande's problem started, because I think in April and May, in the local press, not in the mainstream local press, but kind of the fringe stuff, you started seeing reports about Evergrande not paying its suppliers and creditors on time. And then
they gave their paint suppliers some properties, didn't they?
Yeah, we got to the point eventually where it's effectively barter. We don't have the cash, we're going to pay you in unfinished properties. But that's kind of how sort of set everything off, is that they didn't have the cash, they stopped paying people, contractors stopped working on projects, people became less willing to buy apartments because they look at these projects that weren't getting completed. And so why would I buy an apartment that's not going to be delivered until a year or 2 years' time? And that just snowballed its liquidity problems into a point where today it doesn't have the money to repay its bonds. So that was kind of that's sort of the broad problem as it's kind of snowballed. But I guess the real question is, is this a Lehman moment? Which, I mean, the problem for me in sort of seeing it through that prism is that there's nothing about Evergrande that's going to freeze up China's financial system. There's nothing here that's going to throw growth into reverse. Evergrande itself, to the extent that it can have a contagion effect on the economy, it's likely to be sort of a slow, it's likely to play out more slowly. And I think really that the real significance here is, as much as anything, kind of a broader impact on the property sector that is sort of emerging from the fallout from the 3 red lines, which I mean, this is not the first major developer to default this year. I mean, we've already had 2 other defaults by...
Right, so why aren't we seeing this occur? People are talking about the Lehman moment for Evergrande, but what led up to the Lehman moment was probably over a year and a half of developments and a slowdown in the property market, et cetera. And now we've been at least a month, probably well more, into Evergrande and all this that you described, and we don't really see any sort of well, there's a little bit of follow through, but I would think that when people are prepaying for homes that aren't built and they're seeing problems at Evergrande, that they'd start and pause and say, well, what about the one that I'm about to do? Why are we seeing that and just not hearing about it in the Western press, or what?
No, I think that's the right question to be asking. To the extent that I think that there could be contagion from this, it's people wake up and go, this developer over here seems to have the same problems as Evergrande. They're not paying their suppliers. Maybe I just sit back and buy from somebody else, or just wait to see if if things improve. That's the mechanism, I think, that they could have contagion, because I don't think that's something the government can control. If there is a change in consumer psychology, that's not something I think the government can fix, like a liquidity problem. Which
why wouldn't there be a change in consumer psychology? I mean, in the United States during our housing bubble, it started sort of developing over a long period of time before Lehman. But it certainly, you could measure it and see that housing prices peaked, and people became more reluctant. Purchasers and lenders became more reluctant, et cetera.
Well, just maybe one thing, Denny. I know Zeb had a great follow-up question that we were discussing last night that kind of gets to that point. I mean, and I think from an earlier conversation you and I had, I have heard people talk about this Lehman moment. It seemed to me what's more appropriate example might be the BNP Paribas moment from August 2007. That was when their money market mutual fund essentially halted redemptions because people realized that the asset class had kind of gone sour. And that's when the credit markets really kind of blew out in terms of credit spreads and everything in the US. And to me, that was like the official watching the market at the time, that was a starting gun for this. And so maybe then, Zeb, if we go to the next slide, this was the question that you had kind of raised in terms of, frankly, like well, go ahead.
Okay. So, okay, I'll deal with both of those. I mean, what in terms of Zeb's question of like, okay, why aren't we seeing any fallout so far? And there's a few reasons for it. Firstly, China doesn't really have a unified property market. From city to city or between tiers of cities, like, the first tier, which is, your Shenzhen's and Beijing's and Shanghai's, and then sort of, second tier, affluent regional provinces, and then smaller and smaller cities after that. There is really a different dynamic from city to city. And so you have seen examples over the last couple of months of some smaller cities, the third tier and fourth tier cities, places that we kind of worry already are shrinking cities because of China's demographic problems and because of the natural population flows towards more developed and affluent commercial centers, that some cities are already losing their population. And in places like that, local governments have put into effect rules limiting, putting a floor under the price at which local governments can charge, at which property developers can charge for apartments. It's effectively saying it has to be at least cost plus a certain percentage. Now, these aren't the sort of cities that are going to roil the entire market. I mean, places like Zhangjiakou aren't exactly household names outside of sort of, certain regions in China. But the point is that, we're going to potentially see the fallout of Evergrande and that sort of changes to consumer psychology affect different parts of China in different ways based on pre-existing conditions. So that's the first thing to keep in mind. The second thing to keep in mind is that, that this is not the first time that people in China who have paid for apartments in advance have effectively been left in the lurch, have bought apartments in advance from developers that have subsequently defaulted, and they've been left scratching their heads going, I don't know if I'm ever going to receive my apartment or when it's going to happen. I mean, literally, we've had hundreds of small developers default over the last few years and collapse. We have had a lot of consolidation of the property sector, but we've also had collapsed firms in there as well. And relatively, certainly nothing on the scale of Evergrande, but I can think of 6 reasonably sized developers that have gone bust over the last 18 months, and you've had home buyers who, in some cases, in most of those cases, are still waiting to receive their homes. Now, those instances haven't changed consumer psychology. If anything, people have been just as willing to pay for their apartments in advance over the past 6 months as any other time. Now, the reason Evergrande is different is because of the sheer scale of the number of people who've bought from this company. I think we're talking about 1.6 million apartments have been pre-sold to Chinese people in Evergrande developments. There's something like more than 1,200 developments spread over almost 300 cities. So the question is, given that scale, is this going to change consumer psychology? And one of the reasons why it might not is because at this point, I think it's fairly clear that the government doesn't care about Evergrande as an entity. For all those reasons I talked about before, Evergrande as an entity is not worth saving because of its creative financing, because of its debt. What the state is interested in preserving is the projects. Its number one priority is ensuring that the projects get finished. And so by hook or by crook, they are going to push to make sure that people who prepaid for their apartments get them. Now, a lot of them aren't going to get them on time. There might be a delay of 1 or 2 years, but the point is that that's going to be the priority. Now, it's also not going to be a straight line. In the perfect world, what will happen is that Evergrande will be pressured to sell off whatever viable projects it has to other developers. Vanke, China Resources Land, pretty much whoever's willing to buy. If there's a development in a city where a big developer doesn't want to step in, you're going to find local governments sort of push their own local state-owned enterprise. You go buy up this one. We've got to get this finished. But then you're going to have a problem of there are already questions about how has Evergrande structured a lot of these projects. It seems to already be having trouble selling these off, just anecdotally. So are they overladen with debt? Are they laden with so much debt already that there is no residual economic value to any of these, that it's not worth a third party coming in to buy? And if that's the case, then having some other developer step in to finish these projects is going to prove difficult. So if they all remain on Evergrande's books, then the problem starts to get a little bit more complicated. Are local governments, is the pressure on local governments to find the resources to step in and buy an overly indebted project, is that pressure going to mount? Because I think at the end of the day, that's who is going to be responsible for ensuring the projects get done. It is local governments are going to be forced to make a decision as to, can I ignore this project? Can we just say we write it off? And in some cases, if pre-sales haven't been done yet, a lot of local governments might just be happy to have the empty shell of an Evergrande development in the middle of their city and just leave it there indefinitely until better times. But if there are pre-sales, local governments are going to be very worried about social instability, because there is a leadership transition coming up in the middle of next year, and nobody wants protests, regardless of how small they are, on their watch 12 months out before a political transition. And so there is going to be this pressure to mobilize the finances to ensure that if a developer doesn't step in and buy Evergrande projects on market terms, that these projects get done anyway. And if they get done, then maybe there won't be this impact on consumer psychology after all. A lot of ifs and buts in there, I know, Zev, but that is how.
But what about the wealth management product side of things too, which I don't think you've touched on that much. We've read some about that, and that's the other part of where consumers are exposed here. Could you talk to that?
I can. So the thing about the wealth management products is that what we call things can be quite important. So whereas we have labeled these things that Evergrande has defaulted on as wealth management products, they aren't wealth management products in the same way as we have traditionally understood them, right? So usually when we talk about wealth management products as being an important part of China's shadow banking financial system, we understand them as being investment products that are issued by the banks. Yeah, they're effectively a tool whereby the banks raise money to make loans and the banks provide some sort of implicit guarantee. Evergrande's wealth management products are not that. Evergrande effectively set up its own freestanding financial institution and created its own investment products without the involvement of the banks at all. So this freestanding financial institution originally started off as a peer-to-peer financing platform. And then when the regulators cracked down on that, it evolved into this, this investment platform. So when we're talking about consumers, most of the people that have invested in these investment products created by Evergrande are Evergrande's own employees and its own suppliers and contractors. Now, that's not to diminish the losses those people are facing, but the point is that what Evergrande has created does not reflect this sort of ocean of wealth management products that has been created and backed by the banking system. It is kind of this very unique subset of the financial system that is very much Evergrande's own unique creation. And if something, and its failure to repay these things doesn't reflect on this broader universe of things that we understand as being wealth management products.
Well, that's a really important point, Denny, because I can tell you when Zev and I have kind of debated this internally, that's really one of the points that we kind of come back to is when you think about avenues for potential contagion, that's why we kind of use that BNP Paribas example, because that was, of course, private label subprime that grew up in the U.S. credit system that was not guaranteed by the big guarantors, the Fannie Mae's and the Freddie Mac's. And as so much speculative growth took place in that, it was a real aha moment when people couldn't get their money back. And that really kind of prompted a reassessment of that whole asset class. And so perhaps we're trying to overfit that example, but that's why I think we're kind of sensitive to this is, and it's one of the reasons, I guess, you just, you literally have to go through these things and watch what happens. It's very hard to forecast with accuracy because it kind of depends on how people react. You know, I mean, in retrospect, I don't know how many people understand that failure in August of '07 was really a key ignition point for the U.S. global financial crisis. But that's why I think we're so attuned to that example.
No, that's fair. No, I think it's interesting with the whole wealth management product thing in China, because what Evergrande has been packaging is not just an outlier in terms of, you know, it's the issuer rather than the banks, but even the content of what's the investment product. I mean, the ecosystem of wealth management products produced by the banks up to about 4 years, even 3 years ago, was really one of the key, you know, focal points of risk in China's financial system, because you had all these, you know, effectively what were loans? Loans to parts of the economy that the government didn't want banks extending additional credit to. It was loans to property developers, to local governments, to, you know, heavy industry, overcapacity industries. So it was a real potential center of risk. But over the last 3 years, the banks have been forced to massively reduce the content of these WMPs, which are actually loans. These days, WMPs are primarily a vehicle for mobilizing savings and investing them in the corporate bond market. So the nature has changed somewhat. I mean, the risk is still there, but certainly not on the same scale.
Well, and just a quick follow-up question for you there, Denny. You were kind enough to share with me, you know, some of the analysis that you kind of thought through on that. But I think there was still one issue that was there, which was this issue of maturity mismatch, as I recall. It's that these wealth management products are almost exclusively or largely kind of quarterly. And so that's clearly a shorter maturity, but they are investing in kind of longer duration assets. And so there is some fragility in that relationship that people are depending upon the constant, you know, re-rolling of that short-term debt. I mean, you know, is that the right way to think about this? You know, that timing mismatch still is out there?
Actually, not anymore. So when the government rolled out these new rules governing wealth management products in 2018, the average lifespan for what they call non-standard assets, which is effectively loans. So the loans that were packaged into wealth management products typically had a maturity of something like 400 days, but the maturity of the wealth management products on average was something like 70 or 80 days. So it was complete. I mean, that was the problem. I mean, you nailed it. It was just the potential for things to go pear-shaped because of that maturity mismatch was just, yeah, it was inordinate. And that's one of the things they've tried to rein in. And so we've seen this massive decline in the value of, in the amount of non-standard assets, loans that have been packaged into wealth management products. As they've matured, they have been replaced. A significant portion of them have been moved back onto the bank's balance sheets. The banks, it's quite interesting, the banks have, over the past 12 months, bank impairments of loans haven't increased that aggressively, but their impairments of non-loan financial assets, a very large proportion of these seem to have been moved onto their balance sheet from the wealth management products. I mean, that's really been where the growth in bank impairments have been over the past 12 months. So there has been this real move to kind of flush loans out of the wealth management products, and in particular, get rid of this maturity mismatch issue. And I think the regulators are reasonably happy they've been able to do it because they now demand a degree of transparency in wealth management products that just did not exist even 3 years ago. So I remember when I would look into a prospectus for a wealth management product, and it would say that if you invest in this product, we can tell you that 80% of the funds will go towards bonds and 20% will go towards some sort of credit asset, inverted commas. But that was the amount of transparency they would give you. They wouldn't give you any idea as to how much would go into corporate bonds, let alone what those corporate bonds would be. But today, the banks are required to give a very precise inventory of everything that they are investing in, investing the funds raised from a wealth management product in. So not just that we're investing in bonds, but we're investing in corporate bonds, and these are the specific corporate bonds that we've invested in, and then provide regular updates of just how much of these funds, what is the actual market value of these assets on a regular basis. So I mean, this being China, the banks are always looking for ways to kind of get around the rules at the margin, but there is a degree of transparency there today, which makes it very difficult for, for banks to kind of abuse this system in the way that was just commonplace even 3 years ago.
Well, talking about kind of transparency and everything, Denny, thanks a lot for that deep dive on kind of wealth management products. I guess one of the things that perplexes me on the outside looking in is how that's related to these local government funding vehicles. And, is there any opportunity for, what is the nature of that kind of interrelationship? It's hard for me to kind of tease out that detail.
Yeah, I think if anything, so that, the local government financing vehicles have kind of been this essential tool for local governments to, raise the funds that they need to, to do public works and infrastructure construction and whatnot. Because traditionally, since I think the mid-90s, local governments were not allowed to borrow debt directly on their own behalf. And the reason those rules were introduced is because there was a prior episode in the 90s where when they had that right, they went crazy. They just borrowed money, and they borrowed it in such a way where they just kind of abdicated all responsibility for how, for paying those debts back, in the future. And so the central government said never again. And so local governments weren't allowed to borrow, but then at the same time, local governments are responsible for generating economic growth. And the easiest way to do that is to build stuff. And certainly there's been this real pressure nationwide for almost 20 years now to meet China's infrastructure needs. And so local governments needed to raise funds and yet weren't legally allowed to do it. So they created these local government financing vehicles, which were effectively local government owned corporations that would then borrow on their behalf.
With kind of an implicit guarantee, which I was always intrigued by, I think. And this is like $9 trillion or so, isn't it? Denny, these are not small numbers. Is that fair?
9 trillion. Yeah, I think that's a fair figure. Goldman Sachs recently, like in the last 2 weeks, put out a report on this. I think it may have actually been a little bit more than that. The figure is just, it's obscene, and it's mind-blowing because these days the central government refers to the local government debt borrowed by local government financing vehicles as hidden debt. Because about 5 or 6 years ago, they changed the rules and they said, okay, we're now going to let local governments borrow directly. We're going to allocate them a quota of bonds that they can issue each year. And by doing it this way, we will give them access to debt. We'll be able to monitor how much they borrow, and the whole system will be far more safer. And of course, it just became an additional channel through which local governments could borrow as opposed to an alternative channel. And so they borrowed the bonds, but you still had all these local government funding vehicles. And according to Goldman's recent report, that figure has just kept getting higher and higher. So the central government now refers to local government funding vehicle borrowing as hidden debt. And it's become a huge priority, particularly since the beginning of the year, that they need to rein in hidden debt. The problem is they just don't have a good way of doing it, because if you start shrinking the amount of debt that the local governments have, that's just asking for localized financial crises, because so many of the local governments are financially overstretched as it is. You kind of see it in the bond market, you see it in the interbank lending market. We kind of look at China, it's state-owned, everything's backed by the government. Hence, in theory, all levels of government should be able to borrow money at the same risk-free rate. But if you look at the rates that the banks lend to each other, if you are a bank from Liaoning province, if you are a bank from Guizhou or Yunnan, you're paying a premium to buy from other banks. Why? It's because the banking system doesn't trust that your government, when push comes to shove, will have the same sorts of resources to be able to deploy in a pinch to ensure that that I as a creditor won't have to take losses. And so this kind of comes to the heart of the local government funding vehicle. It's not so much that they've borrowed a lot from shadow banking. It's really the problem, which was a huge problem for years. Now it's that the central government is saying, okay, we've got to clean this up. You've got to rein in your lending at the very moment that they are just financially overstretched as it is, And those stresses are starting to turn up in financial markets.
Well, there's so much that's good in there. There's two things, Denny. You know, one thing that is intriguing me about this, right, is that idea of this implicit guarantee, because, you know, there were many implicit guarantees that were in the U.S. financial system in the early part of the financial crisis, and those ended up having to become explicit. But there was a lot of damage that was done from what looked like a promise to a real promise. And so that's one thing that has me intrigued as I watch this. The other thing, and this is kind of one example, I wish I could remember exactly. I think maybe we were in Changsha as a group, and we met with a representative of a local government funding vehicle. And I forget exactly the specifics and size, but I want to say they had borrowed like $200 million to build like a golf retirement center, you know, in some beautiful part of the, you know, hinterland or whatever. And I remember we met with them and asked them about some of the credit metrics repayment, and it was incredibly vague. And I remember walking out of that meeting thinking, you know, if this one small example is emblematic of, you know, the rigor with which these things have been, the money borrowed or the money invested, and how people were planning it, that it was very problematic. And so who knows, it was only one example, but it certainly left an impression on me. You know, and so I suppose that leads to the second question here in terms of kind of, you know, if, well, I think, you know, you've, I think, followed for some time the work of Logan Wright, who is another one of the gentlemen. I think he's a Rhodium. He was a gentleman I met when I was over there. And I think Logan had put together some data that he shared on a recent podcast. It was a little dark, which was, I think it was that the quantity of land sales, I want to say, was down 43% month over month. And so that kind of leads me to ask the question of, well, if the local government, you know, funding vehicles or local government finances are highly dependent upon the sale of land, and land sale, at least the last couple of months, seems to be stalling dramatically, you know, how should we think about kind of the potential for contagion, or how does all this, you know, fit into what's clearly a very interrelated financial system?
Yeah, I mean, you're right. The thing that perhaps poses the greatest threat to local government finances is the potential for land sales to decline and for land prices to decline meaningfully. I mean, it's that sort of thing that kind of undermines everything, because land is both the collateral that allows them to borrow more, and it is the source of income that allows them to pay down their debts. And they need all of that in order to borrow more to build stuff, because so much of China's growth is based on construction. You know, the model is that you build infrastructure, the infrastructure supports additional housing. I mean, that is the circle of life here. And if the local governments don't have the resources to hold up their end of the bargain, then everything starts to unravel. Mm-hmm. Now, the question is whether, you know, the decline in land sales that we've seen over the last couple of months is emblematic of a systemic shift, or whether it's a one-off. Because I know over the last few years, certainly we have seen periods of time where multiple cities have experienced significant downturns in land sales. It was something that I noticed while I was writing the book. You know, land sales in Tianjin and Hangzhou and somewhere else, all at the same time, where, you know, they just could not sell the land that the local governments were trying to sell. Mm-hmm. So it's still an open question whether the fall that we've seen over the last few months represent a shift that's going to be semi-permanent. And there are reasons to you know, think that it's too early to be able to say one way or another. I think clearly there's a bit of uncertainty about what's going on with Evergrande. You know, that just may have spooked people, and confidence might come back. The other thing is that the central government has rolled out a new mechanism for local governments to auction land. And this was only the second auction. The first one wasn't standardized. And so, okay, is this just changes working their way through the system? Now, of course, at the same time, there are reasons to think that something bigger might be afoot. So you take Vanke, for example, which is probably China's biggest developer. Either Evergrande is or Vanke, it's one or the other. But Vanke has a very good reputation. It's the biggest developer, and it just hasn't been present at auctions, land auctions this year. Now, interestingly enough, though, it seems to have been quite an active bidder on distressed assets by developers that have defaulted. So if you take Sichuan Langguang, which has been selling off assets since the beginning of the year and defaulted on a bond in July, it's already sold at least 3 projects to Vanke, and there's, the Chinese press has been reporting that they're in talks to sell off significantly more. Same thing with China Fortune Land, which defaulted in February. Vanke has been buying assets from it. So, is this a system?
And what kind of prices? I mean, are they buying them at like 20 cents on the renminbi kind of price, or is that reported?
They haven't been reported, but I'd be surprised if they were that cheap, because, I mean, ultimately, if they are viable projects, and Vanke is not doing community service, it's not going to go to a 3rd-tier city and you're a 4th-tier city and buy up junk because the local government wants it to. I mean, Vanke is primarily, it operates in the top-tier cities where, I mean, these assets are still really valuable. Like you would assume that, if it's getting it for cheap, it's not a massive discount. That's my 2 cents. But no, we haven't seen we haven't seen formal disclosures of prices yet.
Well, maybe Denny, a kind of a follow-up question there is, so you've been kind of watching as kind of the peanut gallery marches forward in Twitter and CNBC and all the talking heads are opining on this, not knowing anything. I mean, what's your sense when you watch the commentary? Like, what are people just profoundly don't understand in a lot of the communication you see?
To be honest, Lewis, I try and limit my intake of the peanut gallery.
Yeah, good for you. We're there as well. It's just always interesting to see, there's, of course, in the investing business, you want to have a different view or a different framework, and a lot of times you devise that in terms of how you're thinking differently from consensus. And then maybe just, if I were going to reflect back on the experience that Zev and I had in like navigating the U.S. Housing bubble would become the financial crisis, is that there were these, it moved in fits and starts, and that there were kind of fire breaks along the way, and that there were these lines in the sand that people drew or that the market believed were kind of there. And it was really this progression of deterioration of confidence in an ever widening kind of pool of assets that drove the kind of deleveraging imperative, which is what moved correlations to 1, and why it was such a kind of devastating time in asset classes. And so I guess when we look at this and try to think about that's part of this idea of kind of consensus or whatever, is kind of what are those kind of fire breaks? Because as you were talking about earlier, the Chinese system is kind of a very different, system. I think one of the things that maybe you and I were talking about, and that I've been kind of working, trying to work through, is this idea of kind of credit guarantors, because the credit guarantors during the global financial crisis, this was like the Ambex and Radians and so forth of the day. Those got punished financially very substantially because they were kind of the locus where all the credit risk resided. And so that is kind of a framework I think that I have, and I don't know if there's an answer to that, is kind of where are those vulnerable pools of fire breaks that people have the confidence in that those will hold. And that if they don't hold, then what follows from that? So that's something I'd very much like to be able to identify. I don't know that I have the answer, honestly.
Okay, so I'd say maybe, to frame the question differently, the things that I am kind of watching at the moment for what happens with Evergrande. The first thing, what Zev and I were talking about in terms of consumer psychology, I think that's a big one. If people stop buying apartments in advance, that would potentially have the effect for developers that's equivalent to.
How can we tell that? What are you looking at? That
I think my guess is that you start at the periphery and work in. So what I do is I'm looking at the local Chinese press daily. I gave the example of Zhangjiakou before and kind of scoffed at it, but if I start seeing more Zhangjiakous, then that is something that I'm going to be worried about. I think we've already got a list of about 8 cities that have imposed those sorts of restrictions. If that starts to spread, that's something to start worrying about.
Okay.
The other question, and then of course, the other thing to watch at the same time is if other developers, even if we can't necessarily see that as overtly, the other thing that I'm watching for is, again, in the local press, reports of other developers not paying their suppliers and developers, specifically defaulting on a trade finance tool called commercial acceptance draft, which is really where Evergrande's problem started. Certainly there were reports in the local media back in April and May around the same time that this stuff was propping up for Evergrande, for at least half a dozen developers that were having trouble paying. That sort of reporting has died down, but that's sort of something that I'd be watching for as well. It's kind of liquidity problems. The other issue would be, although this is something I think the authorities are probably in a better position to manage, is that if yields on dollar-denominated bonds for sort of mid-tier private Chinese developers, if those yields start to increase and sort of, they've already have increased, but kind of sort of remain at sort of sustainably high levels for a long period of time, such that Chinese developers, when it comes to roll over their bonds, can't do it offshore without sort of doing it at absolutely prohibitive prices, then you get a situation where they have to come up with dollars somewhere to repay their existing bonds. And, Chinese developers don't have a lot of offshore assets, and what assets they do have offshore aren't really generating much revenue. So they're going to have to, even if they can raise more debt domestically and from a bank or a domestic market, then they're going to have to get dollars from somewhere. And that mechanism isn't necessarily that fluid. Now, of course, I think if the powers that be saw potential for, defaults because developers didn't have sufficient dollars to pay down their dollar-denominated bonds, the foreign exchange reserves would open up and provide those resources. It might not be a completely fluid process, but I think that would happen. But of course, there's a question of what does this mean for the renminbi? Because if you've kind of got, this sort of, need to sell renminbi and buy dollars, then is that going to result in a weaker currency? I mean, you start getting into these sort of knock-on effects at that point. It's not necessarily going to be something that, a weaker currency is not going to sort of knock the economy sideways. Certainly, if you had a whole lot of default by mid-tier property developers on dollar to bonds, that would be far more problematic. But I don't think the authorities would necessarily let that happen. Given the volume of dollars they have, I think they'd share the largesse. It's just a question of making sure that happened in a, in a painless, seamless manner.
Well, maybe there, Denny, a follow-on question is in terms of government interventions. I mean, you said there's a number of things you're looking for in monitoring. I mean, I think I've already seen a few examples of, like, I guess the government kind of coming in and mandating that you can't sell below like a certain value in at least a few markets. Are you seeing any other kind of signs of the first way that they're trying to kind of get in and kind of intervene and stabilize these markets?
The funny thing is, because even as some cities roll out those sorts of measures, in other cities, you're still getting measures to constrain the increases in property prices. So in places like Shenzhen and Shanghai, the concern isn't falling prices. The concern is that housing is becoming unaffordable. And you kind of look at the strategic plans being rolled out by Beijing, the focus is very much on how do we develop a rental market so that housing is affordable for particularly university graduates and migrant workers. And so there's just so many dynamics at work here. And I think this kind of comes back to the question, what I said earlier, is that China's property market isn't a unified market. It can be segregated, it can be segmented by tiers. And, while you have pricing, problems, like overly expensive housing in the first and second tier, once you get into third and fourth and fifth tier cities, then you start to sort of see this perhaps a need to impose, for local governments to impose sort of a minimum price that developers can charge for new accommodation. So yeah, this kind of again speaks to the difficulty of kind of recognizing the trend as being materially significant when you see it, because there's a lot of moving pieces going on all at once.
Yeah. I mean, well, that goes back to the global financial crisis, right? I mean, that, I think it seemed to take forever sometimes, and then all hell would break loose, and there'd be this 6-week period where, madness reigned, and then there would be 6 or 8 weeks of calm, and it was just and thinking back about it or reflecting back on that time, it was the timing was very difficult, right? Because it was really these barriers of confidence giving way on an ever increasing contagion as the asset class distress kind of grew and grew. And I don't think that's forecastable. I mean, I think you can define lines in the sand and understand that when contagion goes from one area to another. But I mean, you can't sit there and say, I've got a really big brain, I know exactly what's going to happen. To some extent, you just have to watch. And that's really some of the issues that, Zev and I are trying to get at in this, as you can tell, is we're saying, okay, where's that line? Where's that line? Where's that line? Because we're just trying to work off the experience we had back in the financial crisis. Well, kind of bigger picture, Denny, if you kind of, if you think back about, I mean, if you try to put, the value of your 10 years of experience in this, and how this has already been a little surprising in terms of how people are following it. I mean, if people look back on this period, what would be your guess? Let's say, it's 3 or 4 years from now, and this has resolved itself in whatever manner it's going to resolve itself, positive or negative. What do you think will be if you had to say, okay, there's one surprise that shocked people, like if people would have understood this one thing earlier in the process, they wouldn't have been surprised by the course that events took.
This is the way I look at it, and this draws a little bit on some of the work Logan Wright has done as well, because I think he's got quite an interesting perspective on this. And his take has always been that systems, whether they be political systems or economic or financial systems, are always at their most vulnerable at the point of reform, and that we're kind of potentially we're really at that point at the moment. So what has been happening since really the end of 2016 is that China has undergone a massive cleanup of its financial system, right? So much of the excess and craziness that I write about my book, the authorities kind of were worried about it and fretting about it at the very same time that I was putting pen to paper. And then they rolled out what they called a deleveraging campaign at the end of 2016. It took a while to get going, but it's best understood as a de-risking campaign. And so over that period, shadow banking has massively contracted. Over the last 5 years, the banks have disposed of something like 10 trillion renminbi's worth of distressed assets. I mean, this is a real, the complexity of the interbank system, which was kind of heading in the same sort of direction of the interconnectedness, which allowed the Lehman moment to happen. China was heading in that direction, but that's all kind of been largely unraveled since then. And so we're now at a position where that process of de-risking has never stopped, because the Chinese authorities, they've got their blood up. They see where the risks are. They see things like the pandemic happen, and they realize, we've been engaged in this very slow moving cleanup. We've probably got another 5, 6, maybe 7 years of doing this thing, but there is the potential for external shocks to kind of come along, knock us sideways, exacerbate the problems, and perhaps even create a crisis. Now, they handled the pandemic incredibly well, but that doesn't necessarily mean that the next external shock will be managed as well. And so this effort to clean up risks in the system are kind of unrelenting. And it's at this point where potentially things can go seriously wrong. And you kind of look at what's happening in the property market. The 3 red lines, you can draw a direct line from that 3 red line policy to where we are with Evergrande today. Now, that's not to say that it's a bad thing that Evergrande is getting sorted out, because Evergrande was a problem, and to allow it to go its merry way, I mean, conceivably those problems would have just got worse and bigger and, just exacerbated over the years. So it's a question of really, did the government deliberately initiate this program? Did it expect to be at this point? Whatever. The long and the short of it, though, is it realized that it could not allow things to continue going the way that they were without some sort of, adjustment. And it's this process where it's actually initiating the adjustments, where it overshoots or it misjudges its own abilities, or the market or the public starts to doubt the government's abilities to be able to manage it. There's a whole lot of different factors that could allow for trust and faith in the system to unravel, or the government to misstep and get something wrong. And I think that's kind of where we are at the moment. And the thing is, this is not just a moment in time. This is a state we are going to be in for at least for some years yet, because this cleanup of the of the financial system, as I said, they've cleaned up about disposed of 10 trillion renminbi's worth of non-performing loans, but that's only about 8% of assets in the banking system. And given the sheer excess and waste that the system indulged in the years after the global financial crisis, I mean, clearly there is far more that still needs to be disposed of. So this is a process that's going to go on for a while, and the potential for something to go wrong is going to be with us for some time yet.
Well, no, that's a really important point. I was going to make an observation, then kind of go to our last question here, Denny. But you know, that was an interesting point in terms of how because for a while, I guess when I first started looking at this, I had my Western perspective hat on, saying the Chinese government's making a policy mistake because they're going after a credit-dependent sector of their economy, kind of with a sledgehammer, and perhaps they don't realize the damage they can do. For instance, the U.S. housing market, in terms of how credit-intensive these things are, the U.S. housing market peaked in the second quarter of 2006 when mortgage credit growth decelerated from 16% year over year to 15%. You know, which is nothing, and that was the peak. And so wearing that hat and looking at the situation, I thought, you know, the Fed would not be so aggressive going after this. The European Central Bank would not be so aggressive going after this. But the Chinese policymakers clearly have made a policy decision that this is exactly what they want to achieve, and it looks like they're focused on doing it. I mean, whether we'll all appreciate the outcome, I suppose, is something that we'll see. And you know, and this leads, I guess, to the last question. You know, just in terms of, you know, Denny, you've been watching this a long time. Who do you think are people that are that we should be following and listening to what they have to say? You know, who do you pay attention to in this?
I mean, Logan Wright, I mean, is both a friend and somebody who's his opinions on this I've always valued. Michael Pettis, I think his work on has been excellent. Sadly, I think some of the best sort of analysts in the business have kind of disappeared behind the paywall in recent years, and so there's kind of few sort of out in the public. Someone I work very closely with, a guy called Andrew Polk from Trivium. He's an economist who I think is good. And someone else I do some work with, Diana Troy-Laver, who's a London-based economist, I think is quite insightful as well. Not on the, you know, she doesn't sort of do deep dives on the financial system, but certainly interesting perspectives on the macro side of things.
Well, hey, that's great, Denny. I can't tell you how appreciative, you know, we all are for you making the time and sharing your expertise with us. You know, it was built over many years, and you know, and now people are kind of seeing the value there. I mean, I would just stress that, you know, I've really enjoyed reading your book. I mean, for everybody who wants to educate themselves, you know, more, they should definitely pick up a copy of China's Great Wall of Debt. You know, if you want a succinct education in something that's complex and we think very important, is not a better place, you know, to start than that. But, you know, but again, thanks for taking time to speak with us from, you know, from Chicago. It's great to, you know, see you again, Denny. And I hope we'll be kind of continuing our correspondence as we see where this thing goes.
No, absolutely, Lewis. And I got a lot of value out of this. I mean, you know, even just listening to your questions even helps me kind of understand what I think I'm seeing in China as well. So this has been incredibly valuable to me.
No, well, thanks a lot and have a great day.
Same to you.
Bye, everybody.
Bye. Cool.